Hi everyone, my name is Stephen Ziff. For those of you joining our webinar for the first time, I'm a partner at Coller Capital and the firm's head of investor relations. In today's webinar, we will be discussing recent trends in the private capital secondary market, and I'm pleased to be joined by two of my partners whom I know are not going to be shy in sharing their views. Hani El Khoury, whose focus is on the private equity secondary market, and Martins Marnauza, who specialises in private credit secondaries. Now, growth in the secondary market has been incredibly strong, with $130 billion worth of transactions closed in 2021, making it by far and away the busiest year on record. And the first half of this year, that trend has continued. And despite global headwinds, volumes have been close to $60 billion. Now, as we head towards the end of the year, we thought it was opportune to share our thoughts on the key trends in, as well as our outlook for the secondary market. Specifically, we're going to cover global trends in the private capital secondary market, the outlook for LP-led and GP-led secondaries, and finally, a focus on private credit secondaries. If you have any questions, please submit them via the Ask a Question button you can see on the screen, and we will get back to you following the webinar. There's plenty to cover, so let's get started. Hani, Martins, thank you for joining me today. Hani, let's start with you and talk about general market conditions. I mean, it's got to be said, we're living through very uncertain times, probably more than most of us have ever known. The global economy is facing significant headwinds, whether you look at inflation, slowing growth rates, problems with the supply chain post-pandemic, and that's before we even get to Ukraine and Russia. Against this backdrop, how does the secondary market tend to perform?
Look, I think now is a great time for the secondary market, simply because the value of liquidity is going up.
Sure.
And that's what we like to see. You have longer hold periods. You have LPs that are looking at distributions drying up. All of this combined with the macro stress on portfolio companies means that a lot of portfolios need to be actively managed. And in the past, this is where we've seen some of the most interesting transactions, where really sellers and GPs are actively managing the portfolio to seek liquidity, to seek solution, to rebalance their portfolios. So I think overall it's an exciting time for us, definitely.
So volatility certainly plays to our strengths. We like that backdrop, that's for sure. I mean, clearly against a market backdrop like this, where valuations are falling, Martins, I want to turn to you next and just think about sort of valuations. We've seen many private market GPs that have been, how shall we say, kicking the can down the road in terms of adjustments to asset prices, perhaps expecting a recovery in the markets that is just around the corner, shall we say. Do you think it's just around the corner? Have we reached the end of the road and valuations are plateauing? What direction do you think they're traveling in?
We're hoping for the best, but we're preparing for the worst.
For sure.
And you're completely right. We haven't seen the adjustment in the private markets yet. That's not unusual. So when we go back to the dot-com crisis, when we go back to the GFC, there's always been a lag, and the amplitude of the adjustment has never been to the same extent that we would see in the public markets. In terms of how we go about our underwrite, is that we very much incorporate the current market dynamics, and so we try and mark the market.
Sure.
In terms of how we price the assets.
And do you think GPs are, how shall we say, realistic in their assessment of valuations? Because they often, will hold back and tend to resist putting a write-down through. And obviously we've got the benefit always, not just in our business, but generally quarterly valuations rather than mark to market. That's what, as you said, That's one of the benefits, advantages of being in the private markets versus public markets. Do you think they are now at the point where they're going to start to put it through, or they'll be expecting some form of upturn?
We would expect a downward trend.
Yep.
We're not in the business of calling the market, so we don't know
Sure.
where it's going to bottom out. But the consensus expectation, the house view, is very much that things are going to get worse before they get better. To your earlier point about sitting it out, it did work during COVID because the recovery turned out to be of a V shape that, again, we didn't expect at the time. We didn't underwrite to a quick recovery, but that's where, as you put it, kicking the can down the road turned out to be a viable strategy. I personally doubt that it's going to be that quick and strong in terms of the recovery this time around.
Okay. So it's interesting, and I want to turn to you, Hani, now, because as we think about what's going to happen in the remainder of 2022, clearly we've got economic turmoil, challenging market backdrop, valuations that, let's just say, maybe have not yet bottomed out. So in terms of volumes, what should we be expecting for the rest of the year?
So maybe quickly on the valuation point,
Sure.
And then going back to expectation. On the valuation for GPs, I think it's a bit of an art how they price the portfolios. But look, I think the art has its limit, and we're coming to that point. In terms of volume, we've seen the first half, strong first half, resilient in terms of transaction volume. I expect this year to be a strong year. But rather than putting a number to this year, the way I think about it is really over the next 2-3 years. And really the expectation over the next 2-3 years is that we will have another record-breaking year in that period. For all the reasons we highlighted, lack of liquidity, longer hold period, needs for unfunded, financing markets that are shut. All of these elements that play in our market are favorable to us as a secondary buyer. So I expect 22 to be another strong year, and I think more volume coming in the next 2-3 years.
It's interesting you touch upon the outlook beyond the current year. I want to turn to you now, Martins, and notwithstanding where the market dynamics are currently. We've seen a huge volume of transactions over the last few years, and it's continued to rise. Just talk me through where you think the market is. Is it balanced at the moment? Where do you see that evolving?
The market is balanced, it's constructive, but remains a buyer's market. So the ratio we track is the transaction volume versus the capital available. When it comes to traditional buyouts, that ratio historically has been in the 4 to 5 times. When it comes to private equity secondaries, the same ratio has fluctuated in the 2 to 3 range. Currently, probably closer to the 2, or even slightly below the 2. And then finally, when it comes to private credit secondaries, that ratio is less than 1. To put it differently, the dry powder that's currently available in the market on the buy side would last a year or 2, given the transaction volumes we've seen. So it remains an attractive market.
Against that market backdrop and dynamics, I want to sort of focus now on specific areas of the secondary market, areas clearly that we as a house know particularly well. And in particular, Hani, I want to start with you and focus on the GP-led part of the market, an area that we've honed our craft in for many, many years. Tremendous growth in that part of the market. Talk us through what any structural changes have been and how these investments are being made and done in this market.
Look, in terms of structural changes, maybe in this year we're seeing in the second half a bigger focus on multi-asset versus single asset, just because, and maybe that's something we'll discuss later. But buyers are tending to prefer diversification versus concentration in this market, and this is the market as a whole. I think what's very interesting in this market is the GPs have realized what tool they have at their disposal in the secondary market, right? And they want to hold some of these assets longer. They want to give them more unfunded. And they want to strike a balance between providing the liquidity to LPs, but also participating in the next phase of growth. And I think the GP-led market and the continuation vehicles strike that balance very well for both GPs and LPs.
And let me ask you this, both of you. You can say, actually, if you think of a GP-led transaction as another exit route for a sponsor, if the IPO market's closed, if M&A is down, what does that mean for a typically secondary buyer capital? Is it, what type of money should that be perceived as if it's the money of last resort? Surely that gives it quite a lot of buying power, purchasing power, when other exit routes may be closed.
No, exactly. That's exactly what we're seeing. And going back to Martin's point, that's why we say it's a buyer's market, because traditional routes have been closed. We are the only liquidity. The value of our liquidity has gone up, and so there's that point around the liquidity, but also in a GP-led transaction or continuation vehicle, there tends to be no need for a new financing package, which is also important in getting the transaction done versus traditional M&A, where most banks are hesitant today to finance. So that financing element, which is not very important on the continuation vehicle side, means that it's a more reliable exit route for the GPs. And we know that the GPs need to exit; they need to distribute, their fundraising. So the motivation coming from the GP is still very strong to use the secondary market for liquidity.
Sure. So, I don't know.
I was just going to add that historically there have been attempts to arbitrage the different exit routes, i.e. the private M&A market and the public and the secondary market. And it didn't really work in a normalized market, and it's definitely not going to work now during a dislocation. However, I think on a relative basis, the attractiveness of the secondary market as an exit avenue is that the GPs are able to craft more bespoke solutions in terms of the liquidity. The secondaries market as a buy side has more flexibility and at the risk of sounding arrogant, but I think often more sophistication, more patience to develop the type of solutions that ultimately are the most optimal for the GP at a price. So I think that's ultimately going to be the overarching factor for anything that happens over the next 12 to 24 months is how it's reflected in the price.
And I'm guessing the fact that we've seen, Hani, to your point, we've seen that shift a little bit away from just pure single asset to multi-assets. That multi-asset portfolio composition also enables that flexibility to be brought in, because you've got a number of different levers to play with.
Completely. And from the perspective of LPs, when it's a multi-asset, it means also almost like a supercharged distribution, which in this market has a lot of value.
We've talked a little bit now about the change in market conditions and what it's meant for the GP-led. Now let's talk a little bit from the LP perception, because I've got a view speaking to LPs day in and day out. But Martins, I want to come to you first. And what are you hearing about the usefulness of the GP-led route for LPs as the market has developed? Are they more accepting of GP-leds?
Definitely, it's accepted, not least on the basis that it's just better understood. Going 5 years.
That always helps.
Yeah, that always helps. 5 years ago, there was a lot of educational work by the GPs, by the advisors, by us as buyers as to what exactly it is, what it means in the immediate future, what it means longer term. So we've climbed quite a steep learning curve over a relatively short period of time. Today, it's hard to come by a large primary program that would not have had experience with a GP-led, either in their private equity book or the credit book. What's interesting as a statistic is that large percentages of LPs do participate proactively in the GP-led processes, and even those LPs who decide not to participate, i.e., to keep the status quo, which is typically given as one of the options, even those LPs predominantly are supportive of the processes, the GP-leds that are taking place. So it's day and night compared to where the market was even just 5 years ago.
So it's clearly evolved a lot, and that's been welcomed by LPs. I mean, we hear quite polarizing views at times. You know, from some LPs, they see it as a great portfolio management tool, particularly with sponsors that they're no longer got a program with, because it helps manage that tail a lot more actively. On the other end of the spectrum, you know, we're hearing from some LPs that actually they're still very skeptical about it. You know, and you know, one of the areas, and I invite either of you to comment on it, one of the areas they ask about is alignment. You know, they are as fixated on alignment as clearly we are on the buy side. And, you know, I just want to get a sense of how, you know, you think about that, be it on the equity or the credit side.
I'm sorry, not everyone is a convert. And that's fine. So I don't think we're ever going to get to a position where 100% are excited and participating, and that would just suggest that there's something, that there is a kind of misbalance somewhere in the system. If it would be,
there's an arbitrage somewhere.
Exactly. So and I think that's really the key for the GP-led transactions is the balance. There are typically three stakeholders at the table: the GP, the LP, and us as the buyer, and the transaction needs to be balanced and work ultimately for all three stakeholders, and that's not always an easy balance to reach, but hence the importance of a sophisticated advisor potentially who'd be involved and helping the process along. Buyers who are experienced in these processes, and ultimately GPs who are acting in self-interest as much they are obviously acting as fiduciaries for their LPs.
That's always a difficult balance to tread.
No, I was just going to make also the point around, from the perspective of LPs, you know, one of the things that come out also is the overall performance of the fund, of that GP, right? Which is ultimately what will drive their decision to re-up or not, or increase their exposure to that fund. So we have to put it in that context as well, that those GP-led within any given fund will be one transaction or two transactions at most. So as you know, as long as the fund is performing and the GP is doing its best to deliver that value, LPs are happy. The one thing on the point of balance, which in the GP-led or the continuation fund structure, what LPs are getting is the upside, or the option to participate in the upside, which is not the case in a normal exit. So that provides a little bit of balance to LPs when they're thinking about those opportunities. There is liquidity, but there's option to participate in the next phase of
the implication is there's going to be value accretion beyond into that period for the continuation fund, for sure. I want to come to LP-led secondaries in that part of the market now and stick with you, Hani. It feels like there's a lot of pent-up demand from LPs. But as we've just talked about, it's a strange time in the market. You know, a lot of volatility, valuation softening, obviously the denominator effect given the fall in public markets, but it's an odd time to be selling. So tell me, what other factors are at play that's driving demand and volume in the LP-led part of the market?
So I think exactly like you said, denominator effect is playing a big role. There's also the expectation from LPs that distributions will now take longer. Asset might be held longer, and that's something that we will see. There's also another element which is on the back of the mind of LPs, which is 2023, 2024 vintages could be very attractive vintages, right? So do I actively manage my current portfolio to make sure I can participate as much as I can in those vintages when they come? So I think that's part of it. Going back to the point of valuation, I think there is also a consensus that's, values, there's a buffer there in private markets.
So people are looking to effectively lock something in, even if it's a discount to where it is today.
Exactly, and I think it will depend on the LP. Different institutions behave differently. Some institutions reject the notion of discount, even though they know the value is lower, and some institution will say, look, we know where the value is, and we're happy to transact. There's a price to pay today, to seek that liquidity, and we're happy to take it. And that's what we're seeing in the market. And frankly, when we look at the LP-led market, we're seeing attractive risk-return profile in that market, given the diversification, given the entry point that we're able to negotiate.
I want to pivot now away from the equity portion of the private capital secondary market to credit. And Martins, let's turn to you. It feels like a new strategy. Clearly for us, it's not. But talk us through what private capital secondaries encapsulates, what it covers.
Sure. It's everything you know about secondaries already, with the twist that the underlying on a look-through basis is private credit instead of buyout. But otherwise, we're doing what, we as Coller Capital, we've been investing in different shapes and forms of credit for the last decade, but really more of the same. So we're still buying very granular, diversified portfolios at the start. So there's that instant diversification out of the gate. We are re-underwriting bottoms up those exposures. And so particularly important today in the current environment where we can reflect higher default rate expectations, lower recovery expectations, etc. We're acquiring those portfolios when they're already quite seasoned, mature. So the remaining duration is shorter, the cash velocity is higher. We're de-risking the exposure quicker. And perhaps most importantly, more often than not, we buy those exposures at a discount, at a meaningful discount. So to give you a feel for what that means, practically in today's environment, we're probably looking to create the underlying loans somewhere in the mid to low 80s. And that's compared, let's say, to the market, depending on which benchmark you'd look at, but something in the 90s. So there's a very meaningful margin of safety out of the gate for us, and perhaps unusually for credit, that discount is also what creates an upside skew to the returns.
It sounds too good to be true. It can't be that easy.
It is good. It's not easy, but yeah. So listen, the market is relatively nascent, and so we, I don't know, by being lucky or smart or a combination of the two, we do have the first mover advantage in a way. We are the largest pool of capital that's specifically dedicated to private credit secondaries. That market is less developed compared to the buyout secondaries. It is very much also a buyer's market. It's even less liquid than the private equity secondaries market, and it's a great time to be deploying in private credit secondaries.
Sounds like it's going to be an exciting time ahead. And just maybe for the audience, what's the investment opportunity set? Is it across all of the credit spectrum, or where do you see the opportunities?
We like to go where we can find the best value. So the mandate we have out of two pools of capital. One is focused on core. Predominantly first lien senior secured on a look-through basis, and there is another pool of capital that we focus more on distress and special situations, etc. But simplistically, think of and I'm just gonna pick on the names at the top of the alphabet. Think of the Arises and Arkmans and Barings of this world, and their flagship senior direct lending strategies. So that's primarily what we're focused on in the core strategy.
Okay, sounds fascinating. Very exciting time as well. I want to now sort of pull the themes together and talk about the remainder of this year and beyond. And I'm going to stick with you, Martins, because you're on a roll from credit. I mean, the market's clearly continued to diversify. Where do you see it growing to beyond this point? Size or the strategies? It's still a tiny proportion of the overall NAV and unfunded. So give us your thoughts.
On private credit secondaries specifically, it's been on a geometrical progression, albeit from a relatively standing start. So we've seen 40-50% growth rates over the last few years. As I think back to when I started at Coller Capital, sure. and you predate me, but when I joined in 2010, the market in the traditional private equity secondaries was less than 20 billion compared to the 130 we had last year. So it's been a sixfold growth in the last 10 years or so. Fundamentally, I don't see a reason why the private credit market shouldn't follow the same trajectory, mm-hmm. but at a more accelerated pace. And the reason why it should be more accelerated is because of the much broader adaptation of the same technology, which is going back to my opening point. It's the same secondaries as we know it. It's just on a different underlying asset. So when it comes to LPs, when it comes to GPs, and these days, as you know, the large cap GPs in particular, but including mid cap, most of them would have private equity as well as credit businesses going. So the technology, the adaptation, the understanding of what the secondary market can deliver in terms of the utility is already there, yeah. and so that should allow us to get to 50-100 billion in the medium term future.
So tremendous growth on the credit side. Hani, just in the market overall, we set ourselves an ambitious target a few years ago and we've talked about the 500 billion, the $500 billion number, but how large could the market get?
Look, the way we thought about it is when you look at a 4-year period, I think the market is doubling every 4 years in the secondary market, and we expect it to continue that way, getting to 500 billion by 2030. I don't think is a aggressive estimate. Even then, it will continue to be a small percentage of the primary market. When you think about the dynamics playing out here, you have the private equity market growing strongly, and then the secondary market growing with that market, and then growth and venture feeding into the sure. secondary market, credit now feeding into the secondary market, infrastructure and real estate, and potentially other asset classes will come to feed that volume growth in the secondary market. The technology that is brought by the secondary market is really applied to any real any asset class.
Sure.
And so, we expect that growth to continue on the same trajectory, potentially stronger, but let's be conservative with 500 billion.
Okay. So it looks like I'm not going to be able to get either of you to pin a number down. But as far as I can tell, I think 500 billion seems a little on the low side. So Hani, Martins, I want to thank you for sharing your views on the market. I'm sure we'll all agree it's a fascinating time to be in secondaries, particularly as the market continues to reach new records, new strategies, and continue to evolve. We are super excited about the market's growth prospects and the sheer abundance of opportunities. And I hope after today, you will feel the same. If you have submitted a question, we will get back to you shortly. And from all of us at Coller, including Hani and Martins, thank you very much for joining us today.